Well, I hope you enjoyed the speeches. As you can see, there was a lot of hard work. Congratulations to the team, and thank you again to the investors that participated in the panels and now in asking some tough questions to the teams. I must say that these questions were very interesting. These are some of the themes that we debated with the teams for over these last 6 months, and that we've worked together with them. But there's always things that can be improved, and I'm sure that the next 6 months here in the office, in our virtual office from now on, will be very, very interesting as well. And now I'd like to sort of invite my dear friends and fellow investors, Carolina from EQT, Vinod from Draper Spree, Fred Destin from Strive, and Frederick Koor from Felix to join us. Hi, guys.
Hi.
Hi. Listen, thank you again so much for your time. I know it's kind of even later where you are. So I really appreciate your sort of time, these 45 minutes that you're going to give back to the community and to the startups that are listening to us and to other investors as well. So I think that as a start, I would ask for every one of you to sort of introduce yourselves and talk a little bit about your firms. And probably the first thing that I'd like you to comment after doing that would be, the elephant in the room. What does COVID mean for the ecosystem and for your startups? What was the good and the bad? Did it really accelerate digitalization? Were there companies that suffered? What's your take on the COVID situation? But before that, just please introduce yourselves. Maybe Carolina, you could start if you don't mind.
Of course. No, hi everyone, and thank you so much, Stefan, for having me here today. Super excited. I'm Carolina. I'm a partner at EQT, which is a global investment firm born out of the Nordics, initially started out in private equity, but has launched a venture fund. And I recently joined over the summer to launch a growth fund. So to be doubling down on European startups. I was previously at SoftBank Vision Fund, have also been at Atomico since before that, and have been in Europe now for about 10 years. I'm Brazilian originally, so my roots tie back to Portugal for a very long time before, but I'm super excited to be here today.
Very good, and we were actually co-investors in one Portuguese company while we were at Atomico. But tell me, so what is your take on the COVID situation?
Yeah, of course. Look, I think it's hard to talk about COVID and not talk about the huge amount of pain that it's caused, both directly in terms of people getting sick, obviously, but the amount of layoffs and people who's had their livelihoods taken away. I think from a tech investor perspective, entrepreneurs, teams, I think tech has benefited. A lot of money has flown into tech, and also in our day-to-day lives, tech is what's made this moment possible. And I think everyone else working from home, learning from home. I've been doing a lot of homeschooling, and then also delivering care, right, digitally as well. So I think from a big perspective, I think there was a moment in May where at least, the companies where I sat on the board in March when COVID really hit, everyone sort of paused. I think investment firms paused, but I think since then we've seen, for the most part, a really positive effect.
Thank you so much. Vinod, you've been a good friend for many years. We've looked at many deals together. Draper are also, by the way, investors in our fund with your fund of funds program. Please go ahead, introduce yourself and tell us what's your experience on the COVID situation.
Absolutely. Well, thanks a lot for having me. It's fantastic to be here amongst the crowd that I'm in at the moment. I'll keep it really short. Look, Draper Spree, we are later stage investors, typically investing at Series A, B, and C, more B and C. We are slightly unique in that we took the unusual step of listing ourselves. And as a result of the IPO, we've been able to do much longer term investments and also make fund-of-fund investments, which is how we've become LPs in Indico and also in Fred's fund, Stride. And so through that, we've been looking at the lens of how does innovation change across the map of Europe? And that's kind of what has led us into thinking about what kind of entrepreneurs would we want to back at a certain point in time. Now, linking that to the COVID question, I think to Carolina's point, the March-April period was triage. Probably each one of us here spent, the better part of 6 to 10 weeks figuring out who needs help, what kind of help can we provide, at what speed. And then, quite quickly, the gates opened up again. So there was two things I felt, at least. So the first is that the world sort of flattened and it all lived on Zoom. So we had Asian investors and American investors all over Europe. And the gates really opened up in terms of the types of deals that were getting done completely remotely, and also the size of the deals that were getting done. So there is a question about, how is capital flowing in and out of Europe at the moment? And the second is across our portfolio, we have companies that were exposed to travel. And as you can imagine, travel has, dropped significantly. So there you have very negative impacts. But across the rest of the portfolio in enterprise software, for example, people have become more attuned and accustomed to selling online. So, you had a compression of sales cycles because now there's less of the need to be at a conference. There's less of a need to actually arrange multi-tiered meetings from this team leader to that person with a budget. It all happened on one Zoom call. So in some ways, I don't think we were expecting that, but that it has impacted enterprise software startups really positively.
Thanks, Vinod. Fred, I remember when we met back in Croatia. We had a good time there, and since then you came to our office a few times. I'm afraid our office is now a little bit closed, but I hope to see you again in our offices soon. You've also launched your own fund after a super successful career in other firms, more or less at the same time that we launched Indico, of course. And so, introduce yourself. You're more than well known by everybody, but please introduce yourself and tell us, with time about your COVID experience.
Sure. So I partnered up. I met a young man called Harry Stebbings. We fell in love. And at some point decided to start a seed fund together. So, it's a labor of love and a passion for us, and that's carried me through my career. I love working at Seed, and that's what we do. So we have the great privilege, I guess, of doing what we love for a living. We focused primarily on the UK, and then we're proudly anti-thematic. I always say we want to be surprised by what founders come up with. They're much better at finding white space than we are. So our tagline is "Dissent is welcome." Please come and show us how we misunderstand the world, and we'll try and follow you. COVID, I was positive in May, and now I'm very firmly positive that COVID has been an incredible accelerant almost across the portfolio. And it's kind of mind-blowing to what extent it's in every sector. So, the value chains held up. There was no liquidity crisis unlike 08, 09. And our companies just benefited from a wind of acceleration in adoption, in methods for selling online. And it's just been phenomenal. So Goldman Sachs came out with some numbers, and they said they measured acceleration in e-commerce generally as 3 to 5 years. And then in some sectors like food, they estimate that it's about 10 years worth of acceleration. So I think we are on the cusp, all the promises of faster adoption and the secular penetration of technology, which have been coming through in the last 5 years, suddenly get a massive jolt. And so I think it's quite a unique time to be backing startups, to be honest.
For sure. We saw that in our own portfolio. Companies like Barking on the pet space, delivering food online, or even Tier, who would have said scooters would be one of the winners in sort of COVID, but we raised lately a Series C led by SoftBank, and so our companies have now raised more than 460 million on the back of the 23 that we've put there, and a lot of it came this year with the COVID situation. Now, Frederick Cook, in this case, we were also co-investors in one of the Portuguese / British unicorns, Farfetch, and you're a big expert in many of these tools that have been doing well. Go ahead and introduce yourself and tell us about your experience of last year or so.
Yes, no, thank you. So I'm looking forward to going back to Portugal, because I miss my very regular trips that I had over the years with Farfetch. So yes, I'm part of the team that launched Felix now 6 years ago. So we also startup firm with a more of a thematic focus. So we've positioned Felix at the intersection of technology and creativity. And so we talk about following the customer across its life cycle, and we talk about the emergence of a digital lifestyle, and that digital lifestyle got really accelerated over the past 12 months. So it was really quite a year, and obviously a year with a lot of stress and really the painful situations for many people, as Carolina rightly mentioned. But it was also a year where we've seen kind of a dramatic acceleration of that digital lifestyle, and people have been embracing technology in a just out of need, just like the way we are having that conversation today. So I mean, it was, I would say, a year in kind of 4 blocks, like the 4 quarters, because I remember last year, January, February started really very strongly. We're also busy. We announced a new fundraising. Having just raised 300 million, so that was our third fundraising at Felix. And then obviously in March, everything kind of froze. So that was after the kind of the quarter of that went from panic to getting on top of things of portfolio. And then from Q3, we've seen things starting to come together. Companies really being on top of their business, starting to see things picking up. And that led to, for most of the portfolio, a very, very strong Q4. And that's valid both on the consumer side and on the B2B side, with a few exceptions, but the biggest caveat being travel. Obviously, we've got 2 investments in travel. So when your market disappears, goes down like 90-95%, it's obviously harder to operate. But luckily, we've got great teams there and also very good syndicates. So it's a year where we've seen, in fact, great behavior by syndicates. It's been really good to see teams getting together, founders, investors, dealing with the uncertainty. And across the themes we are interested in, yes, definitely acceleration around digital commerce, acceleration around wellness has been a big theme for us, from eating better food to taking care of yourself, mental health, where we've invested, to fitness with the likes of Peloton. There's been a drive for people to take care of themselves better, and technology helping in that context. And also everything that was kind of connecting, engaging people with content, whether it was for entertainment or streaming type proposition where we're invested, to content meets commerce, all of that doing really well, as people had more time and were basically more focused on just on that little device, or having even more time for the device basically, and engaging with it. So it's been a fascinating year, and I would say the biggest learning is that, well, on our side, because obviously I won't cover anything that's outside of what we do, but there's also a lot of drama. But on our side, the biggest challenge was learning to work differently for us as a team, for our portfolio companies. And I had a board meeting earlier today, and with the team, where over 50% of the people in the business were hired last year, and creating a cohesion and culture in this context is very, very difficult. And there's also a lot of stress at the moment, because if you look at the news, it's pretty stressful. So it's a tough environment to work, even if your company is doing well, and to some extent even more so, because you're under pressure to succeed, to deliver. So there is generally a lot of stress around, but it's been amazing to see people coming together, and overall within the tech community and our portfolio succeeding.
Oh, for sure. I mean, and glad that you mentioned mental wellness, because we saw it also at Zen Club, one of our portfolio companies that is a mental wellness leader in Brazil, and just shooting up in terms of revenues and engagement. And whenever I guess VCs tell their friends, for us the year was pretty good. People get a little bit nervous or maybe not so happy with the fact that we did really well. But the fact is that technology is helping solving a lot of these problems related to COVID, at least entertaining people through better communication and better content. Now, one of the things that was, I think, even for us VCs probably a little bit surprising, was that actually there were a lot of records in terms of investment that were broken. We saw in the panel earlier today that Europe is catching up. We saw again record numbers in the US in terms of size rounds, mega rounds, and we also saw increasingly the American investors, increasingly understanding that Europe is an amazing opportunity. You probably more than us, we're sort of a local player that delivers startups to centers like London and the Valley, but you are the three of you, the four of you that are in sort of in the center of this world. Do you sense a lot of competition from the big US players, or not really? Are we really catching up as Europe? I don't know who wants to start, but please go ahead.
I'm happy to have a go. I think first, maybe as a macro point, I think right now you're just kind of low to negative interest rates. Equities are probably at reasonable levels. If you look at the low interest rates and the where the ratios are, probably fine. But people have no source of yield, right? So we're seeing this giant wall of capital, and everybody's woken up. Every family office on the planet wants to be in tech, and so we have a wall of cash that's coming in. And a lot of people that are not pricing for risk anymore. So, we see this in the Bay Area, it's insane, where you'll see a company just got funded at, say, 40 pre, and then 4 weeks later, somebody's coming to fund it at 200 pre, right? And so it's like everybody's pricing these companies like they're all going to be successful. And it's it's a little bit nuts, right? And it's a reflection of people really looking for yield and doing whatever to be in the race, right? And everybody wants to be in the pre-IPO rounds, and Frederick managed to get into Peloton and Deliveroo, and great, and so everybody's like, hey, can I get a piece of Peloton, or what the next Peloton might be? So I think some of that behavior is a little bit insane. And then at the same time, we haven't seen price inflation like on the high quality seed investments we do in the UK. The founders don't really have you compete on price. They want a reasonable price, and pricing has gone up a little bit, maybe 20% or something, but they'll come and select you based on whether they think you're the best investor rather than have you climb up a tree on pricing. So thank God we've seen that remain at a reasonable level. Now, I think the US is coming in hard. The world is flattened. I think Benoît made the point. The markets are perfectly transparent. And so last year, look, we have Bessemer hiring someone locally, Lightspeed has a partner, Rightis, who's on the ground, Sequoia is clearly building an office, and Benchmark, Founders Fund, Andreessen, all hunting, and they're using data tools now because all the big VCs who have an industrial sourcing problem will build data tools, and they're hunting. And you'll have people like Coatue. Coatue is a hedge fund. They spent $50 million on the tech platform. So when they deploy the tech platform to go after startups, you have a hedge fund quality level of technology coming to discover these companies relatively early. Same, by the way, EQT has got probably the mother of all, tech platforms in Europe. It's called Motherbrain, which is same thing, to put significant, multi-million dollars to develop a sourcing platform. So you have these kind of industrial approaches to finding and discovering startups and making the market more efficient. So I think competition is global. I think people have to really know what they're good at. Like Frederick is like, hey, we do digital lifestyle. We do software for the creative class. Okay, we know what it stands for. So I think if you don't have an edge, it's getting tough.
Very good, very good.
Yeah, no, I can only echo this. It's really about having an edge, and can be and we see every investment we'll make is competitive. So it was always the case. It's just even more the case. So just the need to have an edge is just increasing. Having more US funds coming with, or not only just US, but just larger funds with more capital overall is good news for the ecosystem and for the entrepreneurs. Obviously not everything is going to work, and there will be some kind of pricing adjustments over time. We see some exuberance in some cases, but who knows? Maybe down the line, this is not that exuberant, and this will eventually work out. But what we see in every situation, and last year we were very active with new investments, We finished investing our second fund, started investing our third fund, and we did a few investments from our growth fund. We, in each situation, there were better offers in terms of price in every single situation. So this is, I mean, that overall it's good news for founders. And then our job is just to draw a line at some point. You know, do we just match, or do we just say, no, this is what we're prepared to do? And in some cases, you know, discipline will be a good thing. In other cases, we will just lose potential opportunities because of that discipline. But we do have to think about our portfolio construction, and it does create some pressure probably on fund size, because every, you know, when Fred and I were looking at seed investments, now we can say like 20 years ago, not seed investment, let's say a Series A was 5 million. Yeah, so that's now, you know, the 5 million Series A days are not totally gone, but they are mostly behind us.
Yes, but it's still a bit crazy that people will just put on term sheet on top of term sheet without any sort of attachment to sort of reality, right? I know we see that much more in the US than in Europe, right? Or does the mother brain in EQT say otherwise, Carolina?
Yeah, no, the mother brain is actually really amazing. And look, I think it's happening across the board. And of course, now I'm really close to growth stage, and you see it happening at growth stage in big valuations, right? Where over the course of 24 hours, a company value will move by over $1 billion from the starting bid, right? Which, you know, objectively is just kind of mind blowing. but it is about the size of the prize. So I totally agree with what Fred says. And I think the additional point of, you know, you have to have an angle yourself. You have to know what kind of tool you are for what job, right? Are you just providing financing? Are you providing something else? And then I think from whether it's thematic or geographical or strategic, you also have to think about what are the kind of companies that you're going to be best suited for, and where do you have a conviction that you think that this is going to be so big that you can become a little bit more price insensitive early on. And I think the difference between now and a few years ago is you see that you have to push the thinking in every instance. And I think it is because the information flow is just so much richer today. So, you know, those diamonds in the rough, those gems, or that asymmetry of thinking about what is going to be great, it's harder to find.
The only thing I'd add, it's, you know, I recall a conversation Fred Destin and I had probably about 3 years ago when we were first talking about whether we could invest in a fund or not. And he described the world through the lens of, you know, the fact that money is the ultimate commodity. And so really it is about the edge, and what does the edge look like? Through my lens, that edge has become nuanced. And so there's a story you tell about what is attached to the money, and then there is the actual money, right? And so the source of capital does matter. So for us, for example, we invest out of a balance sheet, and so it's by definition long-term, it refreshes itself and all of that stuff. But at the end of the day, entrepreneurs are interacting with an individual. And so the other point that was made was about the fact that there is an art form for how this is done. And I think, Fred, if I recall correctly, you called it the artisans of venture. Maybe now it's not a phrase you use anymore, but it reminds me of the fact that there is a craft in what you're doing. Now, as the funds get bigger, you know, so when we go into a round and we're competing with a Tiger or a Co2 or a D1, you know, those guys are hedge funds trying to price risk, or maybe they're not pricing risk in the private markets world. It gets blurred, significantly blurred, because if you show up with a term sheet that is at 400 million pre and somebody shows up at 1.2 billion pre, you are on a different scale, right? And to Carolina's point, that would have happened in 24 hours. So why is there a difference between 1.2 and 400? And that is the question that you know, it's unanswered.
But the question I wanted to ask you about that is you know, what is the psychological effect on sort of entrepreneurs of that dynamic, right? I mean, we've seen examples of things that went super wrong and where egos get completely out of control. And, you know, in the end, as you were saying, we're dealing with people's money, right? Pension fund money and so on. So you can't really play around with that. You know, you have to do things properly, and we're regulated entities and so on. But this dynamic of, you know, increasing term sheets, we all know that this is only played at a very high level and for mega rounds, not so much probably at seed and so on. But is this good? I mean, are we screwing it up as an industry in terms of letting this just get out of control and totally detached from reality and just saying, oh, well, it's just, it's going to be a huge opportunity. Everybody thinks they're going to be a huge opportunity, right? Is this the right thing, or are we creating egomaniacs, out of control?
Look, so just to jump into that, first of all, valuation increases are clearly non-linear. Like, we know this, right? So when companies start to accrete value and they're scalable in some way, they got a flywheel effect or they got some crazy operating leverage, their valuations is non-linear. And so in the non-linear part of the curve, they're super hard to price, right? So, they'll accelerate in value. Look at checkout.com, just raised money at 15 billion. Is that a reasonable price? I don't know. But, there is non-linear acceleration, and that's where the art comes in. What do we know? We know Sequoia lines up 5x funds one after the other, right? And Sequoia is not a low payer. You know who the best payers are in Europe? The best payers are in Europe are Index and Excel, because they actually don't worry about paying up if they're getting against the right assets. So you're back to your original problem, which is, am I backing the best founders? And especially at growth, because you're always thematically investing at growth in some form, it's like, am I backing the winning teams? So then you're back to a question of, do I have the right level of intelligence globally that I'm able to detect these things that deserve nonlinear pricing? So again, EQT has got some baked-in advantages because, you know what? It's a large private equity firm, probably has a ton of information on a global basis. I have a special asset in my backpack, which is called Harry Stebbings, because Harry can get you to any founder in the US. And so we always kind of know how well the US companies are done really fast. And then we're like, well, are we at risk here of being railroaded by US companies raising way more cash? And so the point about that is, now you're playing chess. The moment you get into high value pricing, you're playing chess on a global basis against a limited set of players to capture the opportunity. And so again, if you're Sequoia or if you're Index, your propensity to get into the best is great. And then I think there's going to be a long tail of people who've overpaid for shit. And there's going to be a lot of blood on the walls because they're not in the winning assets and they're just hoping that they are. But again, it's back to, do you know what you're doing? Do you know exactly how you're creating value? If you do, you can pay up. If you don't, you're shooting in the dark. Is my 2 cents on that.
Who else wants to pitch in on this one?
I think we shouldn't convey the impression that the people are just throwing money at anything. There is not every company gets crazy price or very, very high price. People are pricing for growth essentially, and then in some cases we see extreme prices for growth, but it's not because you're in SaaS today that you're going to get Snowflake's SaaS multiple, right? It's or Shopify multiple. These are companies that at scale, you take a Shopify at scale is growing just at an amazing rate, so it does deserve some kind of premium. So if you're a SaaS business growing at 50%, no, you're not going to get 20, 30, 50 times revenue. It's going to be something different. So there is still an element of selection, but what's happening is that what we've seen, take a look at what we did with Peloton. It was a late stage investment. We backed the company late stage. We were the European investor when they did a round that took them into the UK and then Germany. It was a 4 billion valuation. That was very high price, but since then it has grown 10 to 12x. So some of these companies have got the potential to grow tremendously, and that was just 2.5 years ago. So it's still a stock picker. We're still in the stock picking kind of game or business. What has changed compared to 5, 10, 15, 20 years before is that there are more companies that can become very, very large. So there is a much larger field for people to play in.
For sure. What's your view, Carolina?
My view, yeah, look, I think I agree with everything that's been said, and I think it all comes back to the specialization component. Either it is your geography, your theme, or your toolkit that sort of helps you get ahead. Again, it's hard to talk for other stages, but right now in growth, if you don't have a thesis around something, map the space, meet founders early, because I think this is the other thing that is interesting. You always want to build a relationship with a founder. This is a long-term relationship. But what we are seeing in growth is deals done in 24 hours with people founders may never met before. And so there's a few things that are shifting, but I think to Fred and Frederick's point, and Peloton is an interesting one because I looked at that one as well at different points. And if you just did a few calls and understood how unique the product was and the vision and the strategy and the strength of the team, you probably would have gotten away from this notion that might have been prevalent at the time that it was commoditized or it was too expensive. So I think that, the point on the stock picking and the understanding is exactly right.
That leads us to the question about decision-making process inside your firms. I mean, how do you go about that? What do you think are the distinctive characteristics that make you sort of optimize the way that you invest and be effective in making those investment decisions? What would you say? Do you want to start, Fred, maybe?
Oh, I'm happy to let someone else start because I feel like I've been talking a lot. But I'm happy to.
I'm happy to go first. We run a sort of an idea meritocracy with sort of 10 people voting on every deal, and it's generally a majority that has to carry it, and it's got to be a significant majority. But the way in which we avoid sort of groupthink is that the IC is filled with individuals that don't look alike and don't think alike. So we're actually complete polar extremes in terms of how we operate, what we bring to the table, and the way in which we debate the deals. So there is an element of, for example, I lead most of our investing in the fintech world, but I will be receiving input from my colleagues who lead consumer for us, or my colleagues who lead deep tech for us. And actually, it turns out they're all connected thematically. So when I make an investment into a core banking systems player, that is connected thematically to how you think about deep tech companies. And so for us, it's that diversity of thought that we try and encourage at our ICs, which is sort of a rule of how we operate, really.
Let me jump in maybe. So I'm obsessed with decision making. And in fact, we invited Mike Maples to our annual LP meeting. Mike Maples from Floodgate did a little fireside chat with Harry. And Mike said something which I wish I'd come up with. He said, the product of venture capital is the quality of its decision making, or the way in which it makes decisions. It was like, that's the product. And I'm like, you know what? Spot on. So you're only as good as your decision making process. And you have to chase biases like a maniac all the time, because biases will come and they will sediment. And especially in seed, there is no right or wrong. All you can do is you can define the risk universe and understand the risks you're taking. And then you're trying to collectively come as close to an objective vision of the world as you can. That's about the best thing that you can do, right? So you're chasing your own cognitive biases, you're chasing confirmation bias, you're chasing groupthink, all that stuff. And you have to kind of make it explicit so that you know what you're searching. Then you have to encourage dissent. In fact, when you have a group, for example, say 10 people at Draper Esprit, what you're looking for actually is to encourage, dissenting opinions actively, right? And very often somebody who's not, say, I'm an e-commerce guy, right? I've done Deliveroo and PillPack and blah. If somebody who's a deep tech person expresses an opinion that's negative, I can run rings around them if I want to and win the debate because I know my sector better. But actually, what I have to do is take this as a gift, which is to say, if your instinct brings up an issue, I have to try and understand what it is that made you concerned and to help inform my own thinking. Then at the end of the day, when I was at Accomplice, the way we thought about it was, let's always have alignment around the team. In other words, we need to agree the founders are great. Let's absolutely not ask for alignment around the business. right? Because that's how you kill outliers. So let's agree on the people we back, because we hate replacing founders. But then, you know, if we end up with somebody pounding the table saying, I want to do this, and the other three, because we had 4 in the partnership, saying this is shit, we'd be like, if the person was pounding the table hard enough, we should probably let them go, right? So that's how you try and manage that. I would say it's an art form. It's based on trust. Trust is massively important in partnerships, and you have to allow people to take risks because we're not here to avoid losses. We're here to find the exceptional winners. And so, you know, all that is kind of a, you know, it's complicated to maintain the quality of decision making in startups. And I think it's something that certainly I spend a lot of time on. And I think if I was an LP, instead of, you know, asking what did you invest in, I'd spend a lot of time understanding how people make decisions, you know?
Great point, great point.
We are absolutely in the decision-making business. And I mean, the irony of what we do, because we have to make decisions, you know, all the time, but at the end, what will really matter, there'll be only very, very few over a decade that will just make a fund. And let's say, you know, 20 years, they will just make a firm. There are only very few decisions that will matter. And so it's challenging because we always look at something that's gray. It's never just black and white. I mean, if it's an amazing company, it's going to be very expensive. If it's a rough diamond, it's going to be cheaper, but then there'll be some roughness around it, and so there's always grayness. So at some point, we just have to be decisive. It's so I like the point mentioned earlier about bring diverse point of views around the table. That's how we've tried to engineer our team. So we try to bring a fresher point of views, different point of views. I think they will also have the benefit of experience for some of the decisions. But the point about avoiding bias is essential, because if you've seen many things over the years, you've seen many things go right, but many things go wrong as well. So it's quite easy to dismiss something on the basis of that. No, this hasn't worked, or this or that. So we try to use to kind of simplify the decision making around at least someone needs to have a very, very high degree of conviction, and then convey this across the team. So you do need to convey that conviction, and then use this analogy of sort of good versus great, because I think all of the people around this table here will all see really good companies, and when we say no to something, it's not that it's a bad opportunity. Very often we think, okay, we can make a good investment there. There's a good team, but can it be great? So eventually, it's more the art than science that kind of wins, because who knows if it can be great, but we just need to have the conviction that this can be a great investment.
Yeah, and if I can add something to that, what we're doing at EQT, because we're just setting up the fund as a startup ourselves, the first thing we're doing is we're tracking, we vote on Motherbrain. So we have our discussion, and then everyone votes, not just the partners or the IC, everybody. And obviously, with data, or why you like it, why you don't like it, and over time, we want to track that, and we want to see what we can derive from that. And EQT Ventures has been doing that for a while, and there's some pretty interesting insights about how certain votes went and what the company actually ultimately did. We are right on sort of the diversity of background and end of the team as well, and I think we're doing something pretty interesting. We have, and because in growth you're not doing so many investments per year, the level of conviction has to be like you would die on a hill for this company, right? And I think, to go back to Fred's point on trust, right? I think you can have a super spirited debate and you can have different views, but at the end of the day, if you have members of your team and including the deal team, right? Not just the partner willing to die on a hill for something. I think that's what creates, a little bit of the contrarian, finding the edge, believing the size of the outcome. Because I think without that kind of conviction, then certainly in growth, you wouldn't be able to pay some of the prices.
And can I throw something in there, just so for the audience to understand how we're not over intellectualizing this stuff. If you listen to Annie Duke, who is a poker player, and she talks about thinking in bets, very often you have all the data, you make the right decision, you still lose, right? So you can make decisions which were correct. You took the right kind of risk with the right upside, backing the right team, and you still lose, because you know what? Startups lose. And so what's interesting is actually analyzing your own misses. And sometimes you'll go back and you say, you know what? I would make that decision again because it was the right decision, even though the outcome was negative, which is classic of poker, where in poker you can play your hand perfectly and still lose because you know what? There's chance involved. And so the good poker players are able to parse where they make the wrong and the right decisions, whether they win or lose. And I think in venture, similarly, like sometimes you get freaking lucky. Actually, your original decision wasn't that great, right? So you have to parse all that stuff out, and it is complicated.
Yeah, I mean, there's a lot in life which is about luck. There's no doubt about that. And quite often you end up being lucky or unlucky, but that's the information you have at the time and you take the decision that you take. But now, just to close it off, I just wanted your quick advice. These companies that we saw today are very early stage companies. They're, building their product, having the first clients, first pilots, full of ambition and a lot of hard work. What is your parting advice for these companies? Most of you are way ahead in terms of the stage that they're at, but you've seen a lot of companies like this. With your decades of experience of investing, what would you say to these very early stage pre-seed companies?
I can go first. I'd say invest in your team, in anything way sooner than you think you need to. I think that at any stage, an amazing team. And again, this goes back all the way through COVID. There were companies that were in sectors that were crushed, but were incredible teams and found incredible solutions to very hard problems. And so I think sometimes it takes startups because they're trying to be resourceful a bit longer to invest in key roles and build a bench. So invest in your team, hire people better than yourself.
Yeah. Quality, not quantity, I guess.
For me, the thing that stands out is a singular focus and an obsession. So a constant iteration, especially that early on, because that in itself attracts talent to you. And so when we meet with companies, the trouble is, you do end up mapping a certain space. You might have an associate that works with me that has mapped out and said, look, these are the 5 companies that are interesting. But what is it that makes it stand out? It's to Fred Court's point about the good, the good versus the greats. And it's that relentless obsession that just comes across, and that is what stacks odds in your favor.
Very good.
I will refer to something that I think wouldn't have been if we hadn't had very high degree of persistence and self-belief. We would have never done Felix because when we launched. Felix, we closed our first fund in 2015. In 2014, 13, 14, when I was thinking about starting Felix, most people were telling us that it was impossible to start a new fund from scratch that was aiming to raise at least 100 million thematic, from Europe. They really told us it would just not work. So I think it's important to listen to your inner voice and remain persistent and have your own conviction and not necessarily seek for external validation. And just because many companies only exist today because they are doing something that's different. So it's important to believe in yourself.
For sure. I relate to that story when we had to launch Indico in Portugal. We had the same reaction from many LPs, but here we are.
I would say when you're a seed stage founder, everything will conspire to distract you. Your investors will want you to define the metrics you need to raise Series A. The press will compare you to company X. Some clients will waste your time. And so for me, what I've seen work well is first of all, ignore all that shit. Don't go to any conferences. Don't read any blogs. Don't take too much advice. Focus solely and purely on your clients and your clients' need. You can't really go wrong. make decisions every day, including decisions about things you're not going to do. And back to Vinod's point, maintain that radical focus. And I think the more you can purify what you do, the speed at which you make decisions, your focus on the clients, and take all the other crap out, the more successful you're likely to be. So this high metabolism, make decisions very quickly. The reason why someone like Alex Chesterman at Zoopla and now Kazoo is so effective is because Alex makes 10 decisions a day and he doesn't look back, right? It's like you have a problem, if it comes on your desk and it's not been dealt with by a team member and you're the founder, it's probably because it's a hard problem. So it's a complex decision. So you're gonna get 55% of them right and 45% of them wrong. And that's okay. Just make a fucking decision and move. And I think this kind of radical orientation towards action and the refusal of distraction is like the key in my mind between success and failure for a lot of seed companies.
Love that.
Yeah, I think for the audience in Portugal, if you get a chance to hear about the early days of Farfetch and how José Neves started it really at the time when there was no real startup ecosystem in Portugal, and he basically just was following his own instinct, and he was actually not even looking for the tech community validation or even the fashion community validation. He was just going after his vision, and that relentless focus at the time in 2008, where there was such a crisis, has led him where he is today.
For
the
sure.
only exception you have to make is come to the Indico annual meeting every year. That's allowed.
Yes, and listen to Indico investors also when they tell you what are the metrics. Any final words, Carolina? Or
No, nothing. Great discussion. Thank you so much for having me.
very good, guys. Thank you so much for your time. It was super interesting. On behalf of all the founders in the program and everybody listening, thank you so much. Take care, and I'll be right back. We're going to do the closing in just a minute or so. Thank you, guys. Bye-bye.
Thank you all.
Thank you.